it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, they're very similar, but it's a competitive world, and they all know about what a Class A office building in Chicago or wherever it may be is going to produce. So at least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world.
Following the great financial crisis, Warren Buffett stated in a televised interview that if he could acquire and manage a couple 100,000 single-family houses, he would load up on them. So do you ever wonder why he never did it? After all, purchasing and renting single-family houses isn't exactly a difficult task. If you look hard enough, you may discover several hints in previous interviews and shareholder letters as to why Buffett isn't interested in buying rental properties. Today, I will be discussing the 5 primary reasons why we believe Buffett never owned rentals and why you should definitely avoid doing so as well. First and foremost, you must understand and adhere to your circle of competence. Warren Buffett has previously remarked that the most crucial requirement for success in investing are to properly define and stick to your circle of expertise. You cannot attain above-average success by being a jack of all trades. Thus, it is critical to specialize and become an expert in one or a few specific disciplines. In Buffett's example, his early great triumphs were in insurance firms, think Geico, and consumer goods such as See's Candies, Dairy Queen, and Coca-Cola, or KO. Later, as his holding firm, Berkshire Hathaway, BRK.B, or BRK.A, grew in size, he was obliged to broaden his investment universe, eventually investing in Apple, AAPL, and IBM. Buffett, for the most part, has stayed with straightforward enterprises that he understands. Real estate, unfortunately, is not one of those businesses. In a prior annual meeting, Buffett's right-hand man, Charlie Munger, explained, "We have no competitive advantage over seasoned real estate investors. We have no unique expertise in the topic, so we don't spend much time thinking about it. And then there's the real estate that we've actually owned, which I'd say has had a bad track record. That explains why Buffett is hesitant to purchase rental properties even when they are offered at low prices. Second, there is a significant economic disadvantage as compared to REITs. Berkshire Hathaway, Buffett's holding firm, is a conventional business, which implies that the profits it generates are subject to corporate income tax. Charlie Munger says at the same annual meeting, "You receive a whole layer of corporate taxes on real estate properties if you operate as a company like ours, which is taxed under Chapter C of the Internal Revenue Code. Because of our tax structure, real estate is also a bad investment for most people." Then Buffett continues saying, "There are more appealing structures available. When competing with REITs, you just have an economic disadvantage as a C Corp. REITs, or V&Q, are publicly traded real estate investment trusts that pay no corporate income tax if certain criteria are met. In comparison, the corporate tax rate is currently 21%, which would be an additional expense for Berkshire, placing them at a significant disadvantage. The third factor is a high level of management intensity. It is no secret that maintaining rental homes can be a nightmare. Things will fall apart. Tenants may make your life a living nightmare. And when all is said and done, the cash return is frequently not worth it. However, the true return is far lower and may even be negative. Managing rentals isn't always a piece of cake. In fact, the reverse is true. You are constantly dealing with the dreaded 3 T's: tenants, toilets, and trash. And physical structures are continuously degrading, causing everything to break down. The 50% rule of thumb states that after all expenses are eliminated, $1,500 in monthly revenue yields approximately $750 in net operating income, or NOI. That's property taxes, utilities, management, maintenance, trash removal, vacancies, etc. So that's $9,000 in NOI each year, or a 4.5% cap rate, which is still acceptable, but not nearly as much as we originally projected. Then all it takes is one unpleasant surprise to wipe out your entire year's earnings. A tenant fails to pay rent and trashes your property. What happens if the roof begins to leak and causes substantial water damage? Is it possible for a pipe to burst owing to cold weather? Is your tenant suing you because of the mold that got him or her sick? These are the day-to-day difficulties that you confront as a landlord, and even on a huge scale, it is difficult for a corporate like Berkshire Hathaway to earn high profits. The fourth argument is that it is less likely to be significantly underpriced on the downside. Real estate is not technically a commodity. but it is closer to one than a typical corporation. The cash flows are far more predictable, and determining the worth of a property is likewise a lot easier. As a result, market values are more constant, and rental homes are less likely to become significantly overpriced throughout most times. As Buffett puts it, it is difficult under most circumstances. It's a cutthroat world out there. Most of the time, real estate is priced more appropriately. Buffett is a believer in the value of money. He achieves above-average profits by focusing on investments that the market has undervalued. That is simpler to locate in the stock market because it is far more volatile and focused on the short term. That's another reason he prefers equities and maybe REITs over rentals. This leads us to our final point. The last reason is that REITs outperform rental properties. Buffett appeared to favor REITs over rentals in the past. According to an examination of prior annual filings, Berkshire had previously held assets in General Growth Properties, which was ultimately bought by Brookfield, or BAM. He also owns Tanger Factory Outlet, SKT, Seritage Growth Properties, SRG, and Vornado, V&O. His most well-known REIT venture, however, is Store Capital, STOR. Berkshire became their top shareholder in 2017, and they plan to treble their stake by 2020. Their investment is now worth more than $1 billion. You might be wondering why Buffett invests in REITs rather than rentals. Well, it's not far-fetched. For starters, REITs are superior investments for Buffett since they allow him to focus on his area of expertise, while others handle rental management. Second, it is far more tax efficient. REITs are more growth-oriented real estate investments, with the majority of their returns coming from tax-deferred depreciation. This is critical for a business. Third, because REITs are far more variable than rentals. They offer appealing opportunities to purchase good real estate at a discount. Buffett, for example, doubled down on Store when it fell 50% or more in 2020. Since then, the share price has mostly recovered, resulting in a significant gain. Finally, and probably most crucially, because REITs are professionally managed and have significant competitive advantages. They have historically earned better returns than private rental properties. Thanks for staying with me till the end of the video. I hope you enjoyed it. If you did, like and share the video. Don't forget to subscribe and hit the bell icon to get notified when we add new videos in the future. Thank you for watching, and we'll see you in the next video.